This little shaded area in pink, that's where I think that we'll try to still reach up into. It'll be interesting once we get into this a little bit. It can go there and touch it and probably have a nice little retracement. I'd like to see it completely overlap the difference between this candle's close and this candle's open. Okay, see the difference between this candlestick's body and this candlestick's body? It's only got one wick in here. That's a volume imbalance. So in terms of bias, we've not been calling lower prices, but I've been looking for intraday opportunities to push. By example, could frame a exercise, like a practice session on how to read, interpret, get a feel for how far it can run, develop an eye and a knack with experience on fair value gaps and drawing to relative equal highs or relative equal lows, and also getting a feel for the session bias, which is going to define both the buy side and the sell side. Whatever one of those liquidity are taken first, usually the opposite, it goes for that. Okay, so we have another example of that today, and you can see today's action right in here. That's where the institutional order flow entry drill was called real time. So I drew out this idea today, and I was talking about how if we're trying to enter and hold on to longer term moves, I talked about how the Power 3, which is my solution to a conundrum that Larry Williams said he had, it was hard for him to be a buyer below the opening price when he was bullish. So he'd always use buying on strength. And how this is below, that little area right there is below the opening price at 930. But just think about how this, that little part right there, that's basically the 930 first opening price. And then any movement down away from that is to be viewed as Judas swing or a fake move. It's to get people thinking it's going to drop, keep going lower. And then all of this move here is the trend following portion of the move. It means it's all directional, it's all one-sided like this. And then at the close, price will come off the highest high and settle off the high. And I counseled you today. I said, okay, it's after 3 o'clock. If you have not taken anything, you want to pay the trader. Take something off. Why? Because at 3 o'clock, that starts the last hour of trading. The last hour of trading is right there at that low. Just happens to be inside of a fair value gap. And then we have this protraction towards the close of the last hour. So at 3:30, we start this candle. It spools up into that little blue line, which is the close of the daily sell side imbalance, buy side inefficiency. And this is that volume imbalance on the daily chart. Those are all levels that were talked about last Tuesday. But because they're higher time frame, we don't constantly have to refer to them every single day. That's where we've been anticipating price to reach for. Anytime it drops lower, it's done what? It knocks out long holders, scoops up their position, uses their stop loss that's below old lows to buy, and it gets them in sync with this underlying run. So we're going to take a closer look. Just remember, this little diagram represents one daily range, and I wanted you to anticipate the daily range starting at 9:30 here and where we close here at the end of the day. With that in mind, let's dig into the chart on a 5-minute basis. Disregard anything to the left, okay? You're focusing on just this candle right there. That opening tick, we drop, we go a little bit above the opening price, and then we drop once more, go a little bit higher, and we drop more, and we take out the low here and that low. See how those relative equal lows there? We drop lower. We were one-sided. We were anticipating the buy side liquidity resting above these highs right here. But while we were down in here and while we were anticipating the run up, I was outlining how being a buyer, and if you want to hold into trades with a longer term, buying at that opening price or lower when you're bullish. But here, that point of entry right there is the institutional order for entry drill. And we rallied up above what? The new week opening gap high for this week. So Sunday 6 p.m. opening compared to Friday settlement price. That is your new week opening gap. We trade down, then rally, and start to build all of the same aspects of looking for higher prices that we walked through today and have been going through every single day. So let's drop into a 1-minute chart. All right, so we were watching price rip lower. Here's 930 right here. We drop lower. We were looking for the new day opening gap. It trades through it, comes back up. We had an opening range gap in here, running that low out there. And then I told you I want to see it get above the new day opening gap here on the 16th. And then I want to see it trade down. It does so there. And then we had this move with this candle. I outlined the institutional order flow entry drill. And as it did it here, I said, now, if you're looking for a way to hold on to trades, that part's easy once you've done these types of drills for months, because you're not going to fully appreciate where these setups are forming relative to the 930 opening. At that price or lower, when you're expecting higher prices in the daily chart to keep pressing higher, but we're just below that volume imbalance on the daily chart. Are we marching towards those daily and weekly objectives is basically what we're getting at. Because that is higher time frame order flow. That's where ultimately the daily chart's going to try to gravitate to. last Tuesday, August 13th, 2024's live stream, I gave you every level that's pertinent on the higher time frame outside of the intraday charts. And those are like magnets, draw institutional order flow in on those higher time frames. Smaller time frames, as you've been watching me do, it's very, very similar to what we expect on the larger time frames, just get a whole lot more opportunities. So as I outlined today, this is an institutional order flow entry drill. It is the low risk buy. That means it should not come back below that, and it should just keep pressing higher. And we use the new week opening gap here as support. We swept through it, cleared up some inefficiency into the order block right there. There's two of them. So you're using that price right there at the open. So that's a change in the state of delivery. Boom. Now we're rallying. It comes back down to engage that order block and upset any perfect delivery to the new week opening gap. And then, because we were below the opening price at this institutional order flow entry drill, I outlined time. If you get something like this position entry here, you do not strangle it by running your stop loss up. You don't try to keep moving it higher, but you do expect it around 11:30. That's beginning the lunch macro. It will start to drop against the existing movement that took place in the morning session, meaning here you go. It rallies up. And here is 11:30 right there. So at that moment, looking backwards, was it everybody making money on a long or everyone making money on the short? Clearly, everyone's making money on the long. It's gone up longer. It's been up. It's definitely above where we were outlining it live. It's going to seek the initial low that you're going to come to. Here's 11 o'clock. So right here's the price. So you want to go backwards and find the first low, but it has to form after 10 o'clock. Here's 10 o'clock. So yeah, we have a low down here. That's not what I'm talking about. Oh, well, we have a low over here. That's not what I'm talking about. Right here is 11:30. And you want to go backwards and find the first low, and that's this one. Did this low form after 10 o'clock? Absolutely. It's 11:17. So at 11:30, it will seek liquidity that's trailed on that which has been profitable during the morning session. So the algorithm will seek the stops right below that low. Well, wouldn't you know it? It worked again. Not only is it taking out that low, it's engaging the new week opening gap for this week. That's a reasonable expectation. It's going to draw in price to cause more interest. The lunch macro starts at 11:30 and it can go as long as 1:30. It could keep going higher and not have any retracement. But if you start to see it sell off, all you have to do is find the first low at 11:30. Where's the low that you're going to come to first? It has to have formed after 10 o'clock. Why? Because it factors in any run that was created for silver bullet, any protraction in price action that's going higher. It allows you to get the obvious where everybody wants to jam their stop loss to. And that's this one right here. And that's exactly where it went to. And it also agreed with new week opening gap. See that? And then it rallies. So we had all this consolidation. We had sell side taken. And then we entered the 1:30 time there. That closes the lunch macro. There's no more time aspect that's associated with going down to take the stops in this case. So now what is it free to do? It's free to start going in the direction from the early session lows and outlining that daily candle where the open is near the low and the close is near the high. I told you that you would hold on to the trade to minimum 315. Why? Because that starts the last hour's macro. There's 4 macros in that last hour, but I told you it starts at 315 and that one runs to 345. Then you have one at 345 that goes to 4 o'clock. That's the one that we're going to go into and talk about now. So the market rallies up during the 2 o'clock hour, continues higher, and we have a little bit of retracement here going into 3 o'clock. And I said it's after 3, basically time to pay the trader. When we looked at that little crude diagram that I drew out this morning, referencing the daily chart, the daily chart is basically what you see here, where it went up to the high, and then at the close, what's it going to do? It's going to settle off the high. So here's the close, here's the high, and all the way down here is the low today. And that was me telling you that's the low risk buy. And then submit to what? If you want to take longer trades, you have to set your mindset on the time. If you understand Power 3 as I teach it, the highs, and here we are trading as the market opens up at 6 o'clock, trades right up into that volume imbalance on the daily chart. So we've already hit the low. If it never goes any higher than that, it's delivered based on what I told you last Tuesday using weekly and daily charts. That's bias. But intraday, if you're going to hold for bigger runs, the first and foremost thing is you have to submit to the time that's required for the daily chart or daily candlestick to form and close. So if you understand that we're bullish, that's we are indicating today down here. So for you to hold to the close, you have to hold into that last hour of trading, right? And then you also give yourself time when 345 comes. Right there's 345. So what happens is the algorithm will refer back to what? Levels on a daily chart, levels on a weekly chart, and any time frame cycling through less than daily all the way down to the seconds, and it'll cycle right back up. And all inefficiencies will be incorporated, all liquidity will be incorporated, and that's how the algorithm gyrates and moves up and down. And all of this run here, that is algorithmic. It starts at 345. What is it going to spool to? This level, which is the high of the sell side imbalance, buy side inefficiency on the daily chart, and the volume imbalance in that area. Why? Because there's liquidity up there, and the market traded right into it here. That was from the daily chart. It went and hit it just like that. So I gave you on Tuesday where the market's going to gyrate and gravitate to on a higher time frame perspective. But this run here is absolutely algorithmic. When are certain algorithms more prone to create big runs? Well, the last hour macro, obviously it starts at 315, and that one runs to 345. So in and of itself, you have that 30-minute window. And I'm looking for something that's going to cause the move off the high. So like here's the highest high of the day, and then you get this. That's the part that is the 315 to 345. 315 to 345 macro gets disregarded, and they use 345 going into the market on close. Market on close is that last 15-minute window. If it's earnings season, there will be an algorithm that fires at 401, and then you get this crazy run going into 415, and then when the regular session closes, electronic trading goes bonkers, and then you see some wild stuff. This occurred because of what I mentioned today. The Jackson Hole Symposium, it can create volatility. They want to hurry up and get the run over with, basically. Any more run up into this area here that's shaded in pink, it's just a bonus. I don't need to have any more delivery in price to be right about it, okay? You're not going to worry about the little fluctuations in here and completely try to get out because that's the end of the day. No, they're going to drag this thing across the entire spectrum of time, which is taking you into the last few moments of trading the regular session. That's 345. And they ran us up into right there. They close in that SIBI on the daily chart. This candle's low. That's what that blue line is attached to. This is the sell side imbalance, buy side efficiency, and that would be the low. So as I mentioned last Tuesday, we have the mean threshold of this candle here, then the rejection block, then we have the buy side liquidity here, and then we have that candle's low, and we have the volume imbalance between these two candles' bodies. And then naturally, if it wants to go through that, you have the buy side here and the inefficiency there. Ultimately, that's, unless something breaks out in the Middle East, I think we're going to be revisiting here. And after we go there, I don't know if we make a higher high. I don't know if we start ranging for a little while. I don't know if we drop. I don't know. But as a objective for this week, I'm content. At this point, I would favor continuation, what's been shown here, but I'm not forcing anything. So in other words, if I take a trade, I'm not going to go heavy-handed. I'm not going to be doing 10, 15, 20 contracts. I'll do 1, 3, 4, something like that. That's my high end now because it's already done the majority of the move that I was expecting on a daily chart. I mean, think about it. If this is what we've been seeing, we haven't had a down close over 2 weeks. That's unsustainable. So to me, what I think is they're taking out anyone that's short here, and they're taking us up into this inefficiency because it's a strong inefficiency. It's no real volume in there. And maybe we'll get up into here. And probably folks that see that here, they'll think, well, we're going to go for the higher high. And that would be the good area to pull the rug out from underneath everything and send this thing right below here if the coalition of other Arab nations come together against Israel, and then the U.S. gets what it's been wanting for a long, long time, a theater against Persia.